So by far the biggest trend in the technology sector in 2022 was the overall macroeconomic situation. We saw a huge change in terms of how organizations were approaching their capital structure. Prior to 2022, the big focus was constantly on growth, expansion, market dominance, etc. Then, because the interest rates went up and there was a concern about company valuations, organizations became much more focused, particularly because of pressure from their investors, on reducing costs and becoming profitable. This in turn had a number of sort of knock-on effects, particularly around downsizing of organizations, which had a major impact on staff and a number of businesses, and also around real estate footprints, since a lot of organizations ultimately looked at the size of their footprint and are reconsidering whether they in fact need as much space as they have, given both the reduction in workforce and also the increasing move towards remote work. There's a couple of trends we see that I expect to continue, and I'll deal with these both from an economic perspective and also from a legal perspective. From the economic standpoint, I would expect the current hesitation around frothy valuations of companies to continue, and I think we're going to continue to be looking at quite a challenging environment for companies seeking to go public or raise capital. One trend we've seen in Mason Hayes recently is an increase in the amount of bridging finance being used, where companies are seeking short-term loans usually to get them through a specific difficult patch. This is quite interesting because in many cases these loans are in fact secured, which is quite a change from the way in which venture capital finance traditionally worked, which consisted of people putting in equity investment without any security, whereas now we're seeing more security, such as charges or liens over assets being granted. This actually, in practice, means that if the business performs poorly, ultimately it could lead to the investors taking control over the business. In more positive news, we do anticipate that there are going to be companies and successful companies founded and funded in the current environment. During the last downturn in 2010, 2011, 2012, 2013, we did see a number of companies being set up that ended up being very, very successful. We've no reason to think this time is going to be any different. We also are in an environment where venture capitalists have powder to deploy, they have money to spend, and they're going to have to invest that money to generate a return for their limited partners. So we would anticipate that there's still going to be funding rounds taking place. That said, we do anticipate that the next generation of companies are going to have a bigger emphasis on cost control and perhaps may not expand as quickly as we've seen over the last couple of years. What are we seeing on the legal side of the house? Well, in 2023, we're anticipating that we're going to be moving to an environment of increased regulation and more onerous regulation in Europe. In 2022, there was a large amount of new legislation adopted by the European Union, and in 2023, companies are going to increasingly have to grapple with these new rules. To give some examples, one act that was adopted last year is a thing called the Digital Services Act, which significantly extends and refines the content regulation regime in Europe. We're moving from a world where companies simply just have to take down content when they're informed that it is unlawful to a world where they're going to have more proactive obligations. Another law that's having a big impact is the Digital Markets Act. The Digital Markets Act is going to impose further obligations on large tech platforms, so-called gatekeepers, and these obligations are going to significantly limit the extent to which such companies can combine and otherwise use the data they collect. In Mason Hayes & Kern, we're doing a lot of work with our clients in dealing with both of these regimes. Another area where we're anticipating a fairly sizable impact is going to be AI. The EU has adopted a so-called AI Act that's going to impose very significant obligations on really any company that uses general artificial intelligence. And these obligations are going to both extend to the product itself and also things like record keeping and the training of the product. In Mason Hayes, we're anticipating there's going to be a lot of challenges for our clients here, and we've set up a dedicated AI practice under my partner and AI expert Brian McElligott to help steer our clients through those challenges. In other slightly better news, we are anticipating that the EU and the US will reach an agreement on data transfers, probably towards the end of Q1 or Q2 of this year. You can call this Safe Harbor 3.0, as it were, and it will hopefully remove some of the uncertainty around moving data from Europe to the US. That said, we do not regard this as a complete solution, since we anticipate that whatever is adopted will ultimately be challenged by privacy activists, and this in turn will lead to probably about 2 to 3 years of litigation in the courts. So some good news here, but unlikely to be a complete solution.